Welcome back to Elevation Wealth Club. My name is Chad, and today we are breaking down how the stock market works. The stock market might seem complicated, but it's actually pretty interesting once you understand it. It's a place where people buy and sell tiny pieces of companies called shares. In this guide, we'll explain how the stock market works, why it's important, and give you a bit of history about how it all started. What is the stock market? The stock market is like a big store where people trade pieces of companies called stocks or shares. When you buy a share, you own a small part of that company. The stock market is where people come together to buy and sell these shares. Two parts of the stock market. There are two main parts to the stock market. Primary market. This is where companies sell their shares to the public for the first time. It's like when a company says, "We're selling pieces of our company. Who wants to buy?" This is called an initial public offering, IPO. Secondary market. After the shares are sold for the first time, they can be bought and sold by anyone. This is what people usually mean when they talk about the stock market. It's where people trade shares every day. How do people buy and sell stocks? When people want to buy or sell stocks, they do it through something called a stock exchange, like the New York Stock Exchange, NYSE, or NASDAQ. Most of the time, they use computers and the internet to make these trades happen quickly. Types of orders. When buying or selling stocks, people can choose between two main types of orders. Market order. This is when you want to buy or sell a stock right away at the current price. Limit order. This is when you want to buy or sell a stock at a specific price. You wait until the stock reaches that price before your order is completed. Bid and ask prices. When you want to buy a stock, you look at two prices. Bid price. The highest price someone is willing to pay for a stock. Ask price. The lowest price someone is willing to sell a stock for. The difference between these two prices is called the spread. The history of the stock market. The idea of buying and selling shares of companies started a long time ago. Hundreds of years, in fact. Here's how it all began. The first modern stock market started in Amsterdam in the Netherlands in 1602. A company called the Dutch East India Company sold shares to people to raise money for their trading voyages. People who bought shares could make money if the company did well. In 1698, in London, England, a man named John Castaigne started posting prices of stocks in a coffee house. This led to the creation of the London Stock Exchange, or LSE, in 1801, where people could trade stocks more easily. In 1792, in New York City, 24 stockbrokers signed an agreement under a buttonwood tree on Wall Street. This agreement eventually became the New York Stock Exchange, or NYSE, which is now one of the biggest and most famous stock markets in the world. The NASDAQ. In 1971, the NASDAQ was created as the first electronic stock exchange. It allowed people to trade stocks using computers, which made trading faster and easier. The NASDAQ became popular for listing technology companies like Apple and Microsoft. How do stock prices change? The price of a stock changes all the time based on several things. Supply and demand. The main thing that affects stock prices is supply and demand. If lots of people want to buy a stock, meaning high demand, the price goes up. If lots of people want to sell a stock, meaning high supply, the price goes down. Company performance. How well a company is doing can also change its stock price. If a company makes a lot of money, people want to buy its stock, and the price goes up. But if a company isn't doing well, the price might go down. The economy. The overall economy can affect stock prices too. If the economy is doing well, stock prices usually go up. On the other hand, if the economy is struggling, stock prices might go down. How people feel, also known as market sentiment. Sometimes stock prices change because of how people feel about the market. If people are feeling good and confident, they buy more stocks and prices go up. However, if people are worried or scared, they sell stocks and prices go down. Different types of stocks. There are different kinds of stocks you can buy, and each one is a little different. Common stocks. These are the most common type of stock. When you buy common stock, you own a part of the company, and you might get to vote on important decisions. You could also get some of the company's profits, called dividends. Preferred stocks. Preferred stocks are a bit different. People who own preferred stocks usually get their dividends before people with common stocks, but they don't get to vote on company decisions. Blue chip stocks are shares in really big, successful companies that have been around for a long time. They're usually safe investments because these companies are stable and make a lot of money. Growth stocks are shares in companies that are growing really fast. These companies might not pay dividends because they use their money to keep growing. People buy growth stocks because they think the company will be worth a lot more in the future. Value stocks are shares in companies that seem like they're selling for less than they're worth. People buy value stocks because they think the price will go up when other people realize the company is worth more. So what are dividends? Well, dividends are payments that companies make to their shareholders, usually from the profits they've made. Not all companies pay dividends, but those that do often pay them every 3 months. Now let's talk about the different types of dividends. Cash dividends. The company gives you money based on the number of shares you own. Stock dividends. Instead of cash, the company might give you more shares of stock. Special dividends. Sometimes a company might make a one-time payment to shareholders called a special dividend. Moving on to dividend yield. Dividend yield is a way to measure how much money you're getting in dividends compared to the price of the stock. If a stock has a high dividend yield, it means you're getting more money back in dividends for every dollar you invest. Reinvesting dividends. Some people choose to reinvest their dividends by using the money to buy more shares of the company. This can help your investment grow over time, like planting seeds that grow into more plants. How do you start investing in the stock market? Investing in the stock market means buying shares of companies and holding on to them to make money as their value goes up. Here's how you can start. Choosing a brokerage account. To buy stocks, you need something called a brokerage account. There are 2 main types: full-service brokerage. These accounts come with advice and help from professionals, but they usually cost more. Online brokerage. These accounts let you buy and sell stocks on your own using the internet. They usually cost less, but you have to do more work yourself. Setting investment goals. Before you start investing, it's good to think about your goals. Are you saving for something big like college, or are you just trying to grow your money over time? Knowing your goals can help you make better decisions. Diversification means not putting all your eggs in one basket. Instead of buying just one stock, you might buy a bunch of different stocks. That way, if one stock doesn't do well, you still have others that might do better. The stock market can seem confusing at first, but it's really just a place where people buy and sell parts of companies. By understanding how it works, you can start making smart decisions about investing your money. Remember, it's always a good idea to learn as much as you can and think carefully before you invest.